In the decades that I have been providing financial guidance, as a financial planner, as a wealth manager, I have seen hundreds of clients. In all that time, and with all those people, I've actually seen very few mistakes because the mistakes tend to get repeated. So maybe there's 3, 4, 5, 6, 7, whatever the number is. It's not hundreds. There are a couple mistakes that people tend to make over and over in different circumstances, different times of life, but they really hamper their ability to move ahead financially. I want to cover one of those today just to show you how you can avoid it. Let's pretend you were at a bar, at a restaurant, and somebody comes up to you. It's a friend. You're having drinks with a friend, and they say, hey, I got a great investment idea. You get pitched an investment idea from a drinking buddy. Are you really going to take that? Well, maybe, but maybe not. Most people are probably smart enough to go, I'm not sure this guy, he's a great friend, he's a great drinking buddy, but I'm not sure I'm going to take investment advice from him. What if you get pitched an investment idea from an expert in that industry with a very successful track record in that industry? Say Francis Ford Coppola, for example. Look on the screen just to show how successfully some people may or may not be aware of his track record. We've kind of shown all the Academy Awards he's been nominated for or won, all the Golden Globe Awards he's been nominated and won. If anybody knows the film industry, if anybody knows how to make a successful film, you would think it's Francis Ford Coppola. So he saddles up to the bar next to you and you chat with him, and he kind of takes a liking to you, and he says, boy, have I got an investment idea for you. I'm filming a movie, and I'm looking for investors. You might be tempted to put money into that. You might be tempted to put a lot of money into that because it kind of tags all the bases, right? Expert, knows the industry, successful track record. He's investing in himself. I'm going to be right alongside. Why wouldn't you? New York Times article. Godfather director is forced now to sell his watches after losing millions on risky bets and box office. Specifically, he invested $120 million in his most recent sci-fi epic. It grossed $14.3 million worldwide. That's one heck of a hit. This man also collects a lot of luxury watches. One of them, most famous, I guess, is worth $1 million itself. So he's going to have to sell that and the others because of the decades-long project, which he entitled Megalopolis. It just bombed. So what's the mistake here? Besides taking advice from the wrong person, okay? But it did tag all the bases. You'd think, I've got an expert, I've got a professional, he knows, he's got a track record. I should do this, right? The problem here is concentration. This is one of the biggest mistakes that we see people make. Concentrating, putting too much money into one project. If you're going to take a flyer, if you're going to invest in anything, let's say it's not particularly risky, it's just an everyday stock that you think is going to go up, you have to make sure that you limit the amount of money that you put in. So what would a reasonable limit be? Well, if you ask the professional money managers, we want to talk about them a little bit later, but professional money managers would say that if they have more than 5% of their portfolio in one stock, it's concentrated. If they've got more than 10% of their portfolio in one stock, it's extremely concentrated. There's no reason to violate those thresholds. You should never be looking at putting more than 5 or 10% of your portfolio or your net worth, whatever you can't afford to lose, in any one stock. I don't care how good it is. I don't care how much of an expert the person pitching this idea is. You just can't afford to do it because people make mistakes. Experts make mistakes. There are a lot of Francis Ford Coppolas that know their industries. There are also a lot of money managers that know their industry. They still make mistakes. They still have losers alongside their winners. You can't compete with the professionals. You can't compete with the professional money managers who are looking for those very same stocks. They're not going to put concentration, more than 5 or 10% in, but they're still trying to find those stocks. They're competing with you to get the stock at the right price point. You can't compete with that. They have a number of advantages that you are just not going to replicate. Number one, access to information and research. They have professional research teams. They have better data sources. They have access to management. They actually get to get on calls with the chief financial officers, the presidents, the chief marketing officers of the companies in which they're going to invest. So they're getting, it's not inside information, but it is access to extremely important information that is going to be released to everyone at the same time, at least all the professional money managers at the same time. It's not going to be released to the individual investor. Number two, experience and expertise. Professionals have years of training, and then many of them specialize to develop an even deeper understanding of the area where they're going to specialize. Typical specializations would be in large cap growth, or let's say small cap, or international, or even getting more dialed in, they might be doing financial services or the healthcare industry. I mean, this, to use a great example, I was going to say this gets really detailed, but to use a good example, think about the healthcare industry. We all kind of, from a common sense perspective, know that it's a specialized industry, and if, God forbid, you got a heart problem and you've got let's say a shoulder problem or something like that, you are going to need to go to an orthopedic, and you're going to need to go to a cardiologist. Common sense tells us you're not going to have the cardiologist do both work. You're not going to have the orthopedic do both work. You'll have the cardiologist work on your heart. You have the orthopedic work on your shoulder. Money management is the same way. Somebody that specializes in healthcare is not going to know financial services. Somebody that specializes in small cap is not going to know long-term bonds. So these guys and gals, these professional money managers, specialize. Number three, they have the advantages of diversification and scale. They have large pools of capital, so they can take significant positions without compromising that 5 or that 10% rule. They also have lower transaction costs. Because of those large positions, they can go to the brokerage houses that actually make the trades go through. Someone wants to buy stock, someone else is selling stock, and there's usually a custodian or a brokerage firm that sits in the middle, takes the money, exchanges it, makes sure the stock certificates exchange. Well, the larger the trade, the lower the costs for that transaction. There are also economies of scale in their research, the trading, and operations. They got people working for them to look at everything, analyze everything, make sure that the operations run smoothly. They also have access to investment opportunities that come from the private and institutional side of the business. You've heard about, if an IPO comes out, or there's a private hedge fund or a private equity or one of these. Those don't hit the broad market. Those are going to the institutional money managers. We don't have access to that. You don't have access to that. Only the professionals do. They also have risk management tools that are just not available to you. They have access to derivatives, hedging options, and portfolio optimization modeling that will help them diversify and control that risk. They also have internal risk officers, people that just look at all the transactions, all the positions every single day and figure out what might be trending towards too much risk. Even if the diversification issue, the concentration issue has been avoided, you still may have a bad position. All that's happening here with concentration is you're doubling down on what can be bad, on a disadvantage that you have that a professional money manager does not have. They also have discipline and structure that most individual investors do not have. They establish, before they ever go into anything, the specific mandates of what they're trying to accomplish, the risk limits that they will not violate, and then the benchmarks against which they're going to dispassionately look at the investment and decide whether to buy and when to sell and whether to sell. They are therefore less likely to act on emotion or on short-term news. So what's the solution? Well, two easy things. One, diversify. Don't concentrate. Anybody that is investing any significant amount of money, this isn't play money. If you want to have a play account, that's fine. Go do what you want in the play account. But if this is a significant amount of money on which your future, your kids' college depends, you have to diversify, and you have to diversify wisely, which means you have to look at asset categories, large cap growth, large cap value, small cap, very standard ones that have a significant track record, significant enough that we can do some modeling to say this is what the average return will be, this is what the volatility is going to be, this is how it relates to another category, so we can figure out how to put together the mix, the allocation that will give you the return that you need within the risk threshold that you're willing to accept. Once that's done, let's say you come up with your allocation. It's 30-70, it's 60-40, it's whatever it is. This much to stock, this much to bonds. Within the stock categories, I'm going to put this much into large cap growth, this much to large cap value, small cap, international, etc. Within the bonds, this is the amount I'm going to go into munis. This is the amount that's going to go into long term, short term, etc. You've kind of fleshed out now a really, really specific, detailed investment diversification, an allocation that fits your goals. Now what do? Use the professional money managers. Don't compete against them. Professional money managers run index funds. They run actively managed funds. They run mutual funds. They run the largest pension funds in the country. These are guys and gals whose job is within their specialty to live, breathe, eat, sleep that specialty, to identify the stocks to buy based on the criteria that they use. And they're not going to violate that. They're going to be better at it than you are, but they also make their services available to you. And actually for relatively small amounts of money. Some of the index funds, and I'll talk about that just a little in a minute. Some of those index funds you can get into for $500. You can buy a large cap growth index fund for as little as $500. So if you've got $1,000, you can diversify into, let's say, a large cap growth and a large cap value fund. Those funds are going to have upwards of 50, 60, 100, 200 positions, 200 individual stocks that they've purchased inside the fund that you get access to for the grand sum total of, in my example, $500. You can't beat that diversification. You can't try to hire these people privately for anywhere near that amount of money. So what's the difference between an index manager, professional manager, and an active manager? The difference is the index manager is simply trying to put together the diversified portfolio in that sector or that asset class, large cap growth has been my example, that replicates the actual index. Believe it or not, there is a large cap growth domestic index out there. There's a large cap growth value index out there. There's a small cap index, et cetera, and it's defined. It's these number of stocks from these companies in these percentages. Well, the index manager takes your money, my money, every other person's money that's investing in that index fund, takes that larger pool of capital, which you can't replicate, and spreads it out among all those companies in the actual index in the same percentages as the index. You now own the index if you work through a professional money manager who's an index manager. On the other hand, an active manager still should stay attuned and focused to one of those categories. Because remember, this is the age of specialization. This is the cardiologist or the orthopedic. So this is an active manager in large cap growth. He's still going to look at the same large cap growth funds that might be in the index, but he's not going to invest in all of them. He's going to make the bet that with his research, his staff, his smarts, his intuition, he can pick the subset of the companies that are in that index fund that are going to do better. So let's, for example, large cap growth. Let's say there's 200 companies that comprise large cap growth. The index manager invests in all 200 of them. The active manager might say, I bet there's 50 that are going to do really, really well. There's 125 that are going to do okay, and then there's whatever the balance is, 25 that are going to really suck wind. He's going to take the money that you've put into his fund, I've put into his fund, everyone else has put into his fund, large cap growth fund, but it's actively managed. He's only going to buy the 50 that he's identified that he thinks will do better than the index. Now, either approach can be good, and we do use both in our firm with our clients, but obviously we're still using professional money management. We're not money managers. We're not trying to be money managers. We're trying to be, if you will, your financial quarterback, your chief financial officer, where we figure out what the allocation should be, so you're diversified, and then within each of the asset categories that you should be in, which professional money manager and which approach you should use. Should it be an index approach? Great, we're going to use a professional money manager. Should it be an active? Great, we're going to use an active manager. So the way to avoid this mistake of concentration that tanked Francis Ford Coppola, is to diversify and then use professional money management. You do that, I can't guarantee success, but boy, those odds are extremely high. You're going to do well. So that's how you do it. Next time we'll tackle another one of the most common mistakes that people have made. Hope this has been of interest. Love to hear from you.